Now, JEPI, or the JP Morgan Equity Premium Income ETF, is not only a phenomenal income-focused ETF that's generated massive dividends somewhat consistently since inception, but also has went up in price over time, making it, for me at least, an overall solid investment since I started buying it several years back. But now, over the years, there's so many other cover call style ETFs that do things similar to JEPI, such as track the S&P 500 and write cover calls on either a portion or the entirety of the portfolio. So in this video, I'm going to talk about the idea of combining JEPI, the JP Morgan Equity Premium Income ETF, alongside with two other super high quality S&P 500 focused cover call similar strategies. Now, by combining 1, 2, or 3 of these different ETFs all together, you're not only going to have more diversified exposure to not only upside, but also massive income along the way, but also because every single one of these ETFs do have a bit of a different strategy, it could also set your portfolio potentially up for better performance no matter what happens in the future. So if you want to see the two other ETFs that I think would be perfect alongside of JEPI, the JP Morgan Equity Premium Income ETF, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So first off, what is the point of this even? Why would an investor invest into something like JEPI or any of these other ETFs we're going to talk about in this video in the first place? Well, simply put, JEPI, along with these other cover call style ETFs, basically seek upside potential, some more than others depending on the strategy, and also are offering exposure to massive amounts of dividends, distributions, compared to other more basic index funds in the market a lot sooner. Now, with something like JEPI, of course, you're going to get exposure to the S&P 500 for the most part, along with the written on the money S&P 500 index call options, which basically allows this fund to generate a massive amount of premium, which is then, of course, paid out in the form of dividends for investors. Now, so far that sounds pretty good, and you might be asking, well, why would an investor just invest into something like JEPI alone if they want to seek some upside potential as well as exposure to massive amounts of dividends? And I would say, well, even though JEPI has done pretty decent over the max time frame, it's up around 18% plus dividends, so JEPI does have a solid total return, which I'm going to show you here in a second. But there are other similar strategy ETFs, like I said in the intro, that do some things that JEPI does, but also does some things different. Now, before we go into the first ETF, just to show you the total return that JEPI has received since inception, over the last 4.39 years, JEPI with dividends reinvested has given investors an average annual total return of around 13.45% or around 11.6% without dividends being reinvested. So again, JEPI's not bad whatsoever, but I do think these other two ETFs, even though they're very similar to JEPI, I do think they might perform even better, which is why I think combining all three, combining two of them, or maybe just buying one of them could be a potentially good opportunity. Now, the first ETF I'm talking about, this ETF has the potential to not only outperform JEPI in my opinion, but also I think could be great in combination in a portfolio with JEPI, which is what I currently do. I own a ton of JEPI, I own a ton of this one as well as the other one we're going to talk about. I'm talking about the Goldman Sachs S&P 500 Core Premium Income ETF, or GPIX. Now, forgive me if you guys have already heard about this ETF, but a lot of more dividend income focused investors have not heard about this one, and I promise you you're going to want to listen in. So this ETF says seeks current income while maintaining prospects for capital appreciation. Now, this is another very important thing that I think all investors, especially newer investors, need to realize. Whenever you're trying to buy into an ETF, go through and understand what the objective of that ETF is. Now, just because an ETF has an objective doesn't necessarily mean that it's going to play out exactly that way, but at least knowing the objective is going to help you more or less. So right off the bat, GPIX is trying to seek current income while maintaining prospects for capital appreciation. Now, at this point, there's really only so many different ways these cover call style ETFs can sort of differentiate from the others. And this is because the cover call style, although complex, is more or less buying a basket of stocks or buying ETFs and then selling calls on them. But this ETF does it a little bit differently. The overview of GPIX is very, very simple, yet very close to exactly what I personally am looking for as far as my overall investment objective, which is seeks current income while maintaining prospects for capital appreciation. So GPIX is not necessarily going to be an income focused ETF that's only going to be focused on generating a ton of distributions, a ton of dividends, but really sacrificing upside also. Now, I personally don't have anything wrong with those style of ETFs, but for my long-term strategy, especially with where I'm at currently in my portfolio build out and my long-term investing career, I'm looking for different ETFs, different stocks that are going to offer income, of course, but also I still want a large portion of my portfolio to have the prospects for capital appreciation and upside, because although income is very, very important, I still want my net worth as a 32-year-old to keep growing over time along with my age. Now, the strategy basically provides exposure to the S&P 500, but along with that, dynamically sells call options, allowing some participation in rising equity markets. Now, how this is different from JEPI? Well, JEPI sells out of the money call options. And again, if you're not necessarily super up to date with cover calls and selling call options, then this might not make a lot of sense to you, but basically put, this ETF allows the portfolio to ride a little bit more by only selling call options on 25 to 75% of the portfolio and letting some of the underlying ride up, hopefully along with the rest of the markets. Now, this means that this ETF potentially, if the market's in a bull run, could outperform JEPI by a long shot. But the downside of this is because of this ETF strategy, during the market where the S&P drops, there's going to be less downside protection because not the entire basket's going to be covered at one single time. Now, GPIX has offered investors massive payouts so far, around 34-35 cents more or less on a monthly basis, which equates to around 7 or 8% yield and also a very consistent 7 or 8% yield. Not to mention this ETF over the max time frame, which again, it's only been trading for a short amount of time, it's up around 26%, which is insane. Now, GPIX has outperformed JEPI by a long haul. On the time frame of the 1 year, it's up around 36-37% with dividends reinvested, and similar with them nots. So because of the similar yet different strategies, I think it could be a good idea, and at least I personally am already doing a combination of JEPI and GPIX currently in my portfolio. But it's not just those two, I also have another S&P 500 high income strategy inside my portfolio as of right now, and it's also combining SPYI, the NEOS S&P 500 high income ETF, another fund that distributes high monthly income generated from investing into the constituents of the S&P 500 index and implements a data-driven call option strategy. What's different about SPYI though? It does so in a tax efficient manner, and on top of that, it might sell and also buy SPX options, which means again there's going to be massive income potential, but also massive capital appreciation potential. Now sure, this ETF has a bit of expensive expense ratio, but has a distribution rate of around 12.11%, and on the max time frame, SPYI is actually up in the green, up 6.2%. Also along with that, this ETF pays more or less 50 cents, 49 cents every single month and has historically. And although I can't tell the future, I have no idea what's going to happen, I would not be surprised if SPYI, because of the strategy implemented, not only outperforms JEPI, but does just as well as it on average. Now, since inception, SPYI has returned on average around 13.71% over the last 2.12 years with dividends reinvested, and similar returns with them nots. So either way, this S&P 500 high income strategy ETF has also proved itself, at least as of so far, to pay massive distributions and also rise in price a little bit, offering the potential for capital appreciation as well as massive income from day one. So those are two of my other favorite S&P 500 plus option income focused ETFs that I think could be amazing to combine with JEPI like I have in my portfolio, or maybe to buy just one of them, two of them, it doesn't really matter. But what's cool about investing these days, in late 2024, early 2025, there's so many different income strategies, growth strategies, there's really something out there for everyone. So whether you want to buy one of them, combine them, either way, whatever fits what you're looking for, there's probably an ETF out there that's going to check all the boxes. But now lastly, I want to hear from you guys down below. If I were to ask you honestly, if you could only hold on to either JEPI, either GPIX, or only SPYI, which one would it be and why? Drop the ticker symbol in my comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.